All right, CA Interwarriors, let's talk about AS5. Now, this is one of those standards that looks easy on the surface, right? But trust me, it's loaded with little traps designed to catch you out in the exam. So today, we're going to break it all down. We'll go through the key ideas, the common mistakes, and make sure you walk into that exam hall feeling totally confident. Let's do this.
Okay, let's kick things off with a classic exam-style problem. Picture this. It's exam day. You turn the page and you see this question. A company writes back a 5-year-old creditor balance of 50,000 rupees. It's just sitting there on the books, and they finally decide, hey, we're never going to have to pay this, so they write it back. The big question for you is, what do you call this? Is it a prior period item? Just think about that for a second. What's your gut reaction?
You know, I can almost guarantee that 9 out of 10 students get this wrong. It seems so straightforward, but this is a classic ICAI trap. They love this stuff. But don't worry, by the time we're done here, you're going to be the one who gets it right. You won't just memorize the answer, you'll get the why behind it so well, you'll see these traps coming from a mile away.
So to figure out that puzzle, we've got to first understand the playground we're in, which is AS5. Let's just quickly touch on what this standard is even trying to do. Look, the whole point of IS5 is pretty simple. It wants to make sure that when you pick up a P&L from Company A and Company B, you're comparing apples to apples. It's all about consistency, uniformity, so investors can make sense of it all. And it does this by giving us clear rules for these 4 big areas: extraordinary items, prior period items, changes in estimates, and changes in policies. Oh, and a quick heads up for the exam, IS5 doesn't care about tax. It specifically says don't deal with tax implications, so don't even go there. All right, let's dive into the first big hurdle, figuring out the difference between what's ordinary and what's extraordinary. So, ordinary activities. This is pretty much what you'd expect. It's the normal, everyday stuff a company does. You know, making and selling its products, providing its services, all the activities that are part of its main business. It's the bread and butter of the company.
Okay, now for extraordinary items. Pay close attention here, because this is where marks get lost. For something to be called extraordinary, it has to pass a 2-part test. It's not one or the other, it has to be both. First, it has to be clearly different from the company's normal business, and second, it's something you don't expect to happen again and again. Both boxes have to be ticked. Super important.
So think about it. If a court seizes a company's property or there's a huge earthquake, for most businesses, that's definitely extraordinary. But, and here's a classic ICAI twist you need to watch out for. Context is king. An earthquake is extraordinary for, say, a manufacturing plant, no doubt. But what if you're an insurance company and you sell insurance against earthquakes? Well, for you, paying out claims after an earthquake is, well, it's just business. It's an ordinary activity. See how the same event can be totally different depending on the business? That's a key takeaway.
Okay, big exam tip right here. If you read AS5 cover to cover, you will not find the words exceptional items. It's not officially in there. But it's a really useful concept we use to understand something important. Exceptional items come from ordinary activities, but because of their size or their nature, they're so significant that you have to show them separately. It helps people understand the company's real performance. We're talking about things like a massive write-down of inventory or settling a huge lawsuit.
So let's break it down really simply. The number one difference is where they come from. Extraordinary items are from outside the normal business. Think of them as external shocks. Exceptional items bubble up from inside the ordinary business. They're just unusually big or weird. Getting this right, understanding their origin, is how you avoid a huge trap in the exam. Okay, so now that we've got that straight, let's go all the way back to that first question about the creditor. This leads us perfectly into the next big piece of AS55, prior period items. And you'll notice I put the word errors in quotes there. There's a very good reason for that, as you're about to see.
Okay, this is it. This is the single most important thing you need to know about this topic. The definition hinges on 2 words: errors or omissions. A prior period item is only created if you made a mistake, an error, or an omission when you prepared the financials in a past year. If there was no mistake, there is no prior period item. End of story. It really is that black and white.
So what counts as an error? Well, it could be a bunch of things. A simple math mistake. Applying an accounting policy the wrong way. Maybe you misunderstood some facts back then. Or, just straight up forgetting to do something, like not recording an expense you should have. All of that counts.
And here we go. Let's solve that question from the start. Is writing off that 50,000 rupee creditor a prior period item? The answer is no, it is not. And why? Let's use our rule. Was there an error in the past?
Did the company make a mistake by showing that creditor for the last 5 years? Absolutely not. They were right to show it. The decision to write it off now is a new development and adjustment in the current year. There was no past error, so it cannot be a prior period item. That's the logic.
Awesome. Now that we've totally nailed the difference between an adjustment and a real error, let's get into the final part of AS5. This is where things get a little more subtle, and ICAI loves testing the small details. Okay, first up, a change in an accounting estimate. Think about it. Accounting is filled with estimates, right? The useful life of an asset, how much to provide for bad debts, it's all about judgment. Now, when you get new information, or you just get more experienced and can make a better call, you revise that estimate. The critical thing to remember is this is not fixing a mistake. It's just improving your judgment based on what you know now. This depreciation example is the perfect way to understand it. Let's walk through it. You buy a machine for 10 lakhs. You guess it'll last 10 years. Simple enough? That's 1 lakh of depreciation a year. Fast forward 5 years. The machine's book value is now 5 lakhs, but you get some new info. The machine is wearing out faster than you thought, and it's only got 2 years left. What do? You don't go back and change the past. You take the remaining 5 lakhs and spread it over the new remaining life of 2 years, so your depreciation for the next 2 years jumps to 2.5 lakhs per year. That right there is a classic change in accounting estimate. So this is the big question you've got to ask yourself every time. Was this change because of a mistake I made in the past? If the answer is yes, you're looking at a prior period item. Or was this change because I have new information that affects the present and the future? If yes, it's a change in estimate. So many marks are lost by mixing these two up. This slide is definitely one to screenshot for your final revision.
Okay, next up we have a change in accounting policy. This is different again. This is when you decide to switch from one proper accounting method to another one. For example, maybe you change how you value your inventory from FIFO to weighted average.
Now this is really important. A company can't just change its accounting policies on a whim because it feels like it. ICAI loves testing this. There are only 3 situations where it's allowed. 1, if the law makes you do it. 2, if a new accounting standard forces the change. Or 3, and this is the one that requires judgment, if the new policy gives a more appropriate picture of the company's finances. And here's another spot where you could get tripped up in an MCQ. The standard is super clear about what is not a change in policy. If your company does something for the very first time, like setting up a new retirement plan, well, choosing an accounting policy for that isn't a change. It's a first-time adoption. Same goes if something that used to be tiny and immaterial suddenly becomes significant. Applying a proper policy to it now isn't a change. Okay, team, we have made it through all the core ideas of AS5. We've talked ordinary versus extraordinary, and we've hammered home the huge differences between errors, estimates, and policies. Let's finish up with one last and super important exam hall tip. Imagine this. You're in the exam hall, the clock is ticking, and you're staring at a problem where the line is just fuzzy. Is it a change in policy or is it a change in estimate? You could probably argue for either one, so what do? Don't panic, don't guess. The standard actually gives you a safety net. And here it is, the golden rule, straight from AS5. If you are ever in doubt and you genuinely can't tell if it's a policy change or an estimate change, you treat it as a change in accounting estimate. You just account for it that way and make sure you disclose what you've done. That is your escape hatch. Remember that, and you'll be ready for any curveball AS5 throws at you. You've got this. Good luck.